In this video, I want to share the results of my 2-month account rotation trading experiment and explain what role each account played, as well as how I plan to adjust the strategy in 2026. Between November and December 2025, I traded 3 separate $100 accounts, all using the same structure. And during this process, I came to one important realization. I'm not just trading to make money. I'm testing a system. Today, I'd like to walk you through exactly what that means. Let me briefly explain the structure first. Account rotation trading works like this. When a trade hits stop loss on one account, that account is done. The next valid setup is taken on the next account. If stop losses continue, the accounts rotate in sequence. In practice, trade on account 1, and if it hits stop loss, account 1 is done. Next setup goes to account 2. If account 2 stops out, next setup goes to account 3. If even account 3 stops out, rotation resets back to account 1. And this cycle repeats. The core idea is very simple. Never concentrate all risk in a single account. By rotating accounts, risk is absorbed first, and re-entries are taken only under relatively better conditions. Here's the combined result after 2 months. Starting capital, $301.79. Current balance, $415.44 net profit, plus $113.64. Total ROI, plus 37.66%. Overall win rate, 61.68%. On the surface, these numbers look fine. But the most important insight in this video is not the total performance. It's the difference between accounts. Let's take a look at account 1. ROI, minus 2.83%, highest number of entries. Most stop losses. At first glance, it's easy to think this account is the problem. But that interpretation misses the point. Within the rotation structure, account 1 is designed to face risk first. It experiences early market reactions, unstable conditions, fast stop-outs. That's why it trades more and stops out more. Next, account 2, ROI, plus 85.42%. Win rate around 70%. The most consistent equity growth, account 2 only trades after account 1 has already stopped out. In other words, it enters under more stabilized conditions. That's why its performance is the strongest. Lastly, account 3. ROI plus 29.59%, win rate around 66%, fewest trades, but steady growth. Account 3 only trades after both account 1 and account 2 have stopped out. This means fewer opportunities but much cleaner setups. As a result, its win rate remains solid despite lower frequency. So here's the important question. Is account 1 useless because it has many stop losses? The answer is no. Account 1 functions as a risk filter. By absorbing early losses, it allows accounts 2 and 3 to participate only when conditions improve. This outcome isn't accidental. It's exactly what the rotation structure is meant to do. So how do we improve this structure? My conclusion is straightforward. The rotation structure and the entry logic stays the same, but position size on account 1 is reduced by 50%, and accounts 2 and 3 remain unchanged. With this adjustment, loss pressure from early entries decreases. Profitable accounts can naturally offset losses. Overall system stability improves over time. Account 1 evolves from a loss-heavy account into a controlled risk-testing account. This should slightly increase expected returns while making the system more resilient to market volatility. There's only one reason I'm doing this. I want to evaluate my trading based on records, not intuition. I don't want to look back at extreme market crashes like October 10th last year and simply say, I was unlucky. Instead, I want to build data that proves it's possible to take stop losses and still grow capital. That's why I'm developing account rotation trading into a sustainable trading system. If you're thinking along similar lines, I invite you to follow this journey into 2026. Subscribe and like the video if you'd like to see how the system evolves with real data and real adjustments. Thank you for watching.